All right, welcome to Markets 101. We're going to cover business cycles. All right, now business cycles, this is a study of economics. And this is where they've gone in and they've really labeled certain environments. And it's kind of interesting, the fact that it keeps happening over and over and over again. And we can look back in history and we can clearly label, well, this was this, this was this, this was this. And one of the things that I have learned, and I remember when I got into trading, I was 22 years old. I was 22 years old. I was a kid. I had never seen a recession before. I had heard the word before, but that's about it. But I'd never seen a recession. I had never seen a depression. I just didn't have enough world experience to understand this. Now that I've been trading for close to 25 years, I've now been through several recessions. I've been through, boy, they're not calling it a depression, but they're calling it the Great Recession in 2008. I've definitely seen now with experience that this is the way the world works. It works in business cycles. And as a 21, 22-year-old, I did not have the experience and the knowledge to understand that this is just a natural, normal thing that happens. So let's take a look at business cycles. Economists have gone back and they've basically identified 4 points in the business cycle. Let's first take what we're going to call the trough. That's the bottom. That's when things are getting bad and all of a sudden they start to get a little bit better. Now look, down here at the bottom, things are still pretty bad. But it's all about the trajectory. Things are getting better. Here we have, all right, things are getting better, and then at some point there's going to be a tip. It's going to be the peak. And then we're going to get a slowdown. And then that slowdown is going to bottom out, business activity is going to return, and it's going to continue. This is how businesses work. This is how economics work. This is a guarantee. Many people think that we can avoid these things. And I kind of feel like the more we try to avoid things like recessions, the more likely we are to get worse recessions. This is very natural and normal. This has been going on from the beginning of economies. So however long there's been economies, we've had business cycles. We've had times when people are wealthy. We've had times when people are poor. We've had times where there's growth. We've had times where there's no growth and retraction. This is just a normal, natural part of the world, and understanding it can give you a great insight into what to do with your money. So the 4 stages of economic cycles we covered in the expansion, the peak, recession, and the trough. So not too hard to figure out just by the terms here. Expansion, things are getting better. And let's quantify better. People are building more things. People are buying more things. Businesses are hiring more people and opening more factories. Government is expanding its reach. So basically expansion, we can really boil this down to one thing: gross domestic product, or GDP. The GDP of that country is growing larger. They produce more this year than they did last year. That's expansion. So whenever you have GDP rising, we are definitely in the expansion phase. Now that can go on for quite a long time. We're going to talk about how long the average expansion lasts, but at some point there's going to be a peak. At some point it will be the end. Now I know people think, well, maybe this economy can go on forever. Well, guess what? It's never done it before. And so history has shown us that there's some point there's always a peak. Now at the peak, things are great. Peak is basically the best it'll ever get. Usually everyone has a job, labor's in short supply, materials are in short supply, you typically have high inflation, so everything is great. And then at some point we get that tip into recession. So recession is just the opposite of expansion. GDP is going lower. GDP is getting smaller. And at some point GDP will go negative. That is the definition of recession. So what happens in those environments? Well, we have businesses, they begin to slow down. They begin to cut costs. By cutting costs, they lay off workers. They cut orders to other businesses. Because of that, those businesses have to lay off workers. Now we have people that are unemployed. And people that are unemployed, they don't consume a lot of goods and services, which means that people are out there buying less at stores, which means that these stores and businesses cut back even deeper. As you can see, it's a vicious cycle to where a lot of people say, boy, this is never going to end. We're in recession forever. I remember back in 2008 and 2009, I remember there were mornings when I woke up as a trader and the fabric of capitalism was becoming unwound. And I remember thinking, wow, these banks are just going out of business right and left. Is there going to be anything left? Well, guess what? It doesn't last forever. This is a business cycle. At some point, it hits the bottom. Now, the bottoms are rough. The bottoms are rough. We have high unemployment. People don't have jobs. The people that have jobs are scared. The people that have money are hoarding their money. They are not out there spending it, buying boats and RVs. They are saving it away, and they put it in very safe, stable investments. All of a sudden, we get very little economic activity. But, again, we're still people. We still have to consume. We need food. We need shelter. We need things. So there is going to be a base level of economic activity. At some point, things will get a little bit better. And when they get better, all of a sudden, companies are going to start making a little bit more money. Because businesses are making more money, they hire more people. More people get jobs, more people have money, they go out and spend, and you can see we're back into the expansion phase. This is how the business works. This is how business works. And it always has, and I'm going to go ahead and say it always will. Now, of course, it's really tough to say always, but in the foreseeable future, this is how it's going to work. Let's talk about the peaks and troughs, because these are the moments that make the history books. These are the moments that are etched into people's minds. I remember back in 2000, I was 26 years old, I was a trader, and the dot-com boom was going bonkers. In 1999, the NASDAQ went up 70% that year. In the first 3 months of the next year, it was up another 35%. It was bonkers. It was crazy. And I remember thinking to myself, and even as 26-year-olds, I remember thinking, okay, this is crazy. Come on, people. Come on, have you lost your mind? But everyone thought, this is the new era. The internet has changed everything. Well, at that moment, euphoria was running wild. People had tons of money. People were spending it. They were buying yachts. They were buying all these things. Businesses were expanding. I remember if you just worked for one of these dot-com companies, you had cars, you had private jets, you had everything. And at that point, that was the peak. At some point, it hit the peak, and it did. And then what happened is it all tumbled apart. When you get to those economic troughs, this is the really ugly point. And I remember as now a 28-year-old, the S&P 500 in 2011, after the stock market had already collapsed, the S&P 500 went down another 35%. People didn't have jobs anymore. Real estate in the Bay Area had crashed. People were getting foreclosed upon. And in early 2002, it was really rough. People were really dejected. Now, I remember as a trader, this was my first recession I'd gone through. And I remember thinking, oh my gosh, it's never going to get better. And I remember when stocks started to go back up, I didn't believe it. I actually started shorting stocks again in 2002. I ended up losing some money, and so I stopped shorting them, but I didn't believe it. I didn't believe it because I had just seen all this pain. I had just seen all this destruction. And so I didn't fully buy in. What did the markets do? They went up. 2003 was a great year. 2004, the Fed started raising interest rates. So I'm like, I can't buy this in here. I was still trading, but I just couldn't buy in. And finally, in 2005, I said, you know what? I'm an idiot. It's an economic upcycle. It's in expansion again. So what happened? The market ran up. Everything was great again. And right around 2007, the price of oil went up to $130 a share. Real estate prices had doubled and tripled. And all of a sudden, we are back to this euphoria. Things were fantastic. Nothing could go wrong. People were buying 2, 3, 4, 5 houses on credit. Wow. Doesn't that sound just like what happened in 2000, but just with a different asset class? What happened? Boom, hit the peak, broke apart. This is the economic cycle, everybody. Now, if you understand it and you know it, you can see these moments. You can see these moments and you can actually put yourself in a situation where you can profit from them. So what are you really looking for these moments? Extreme readings. This is what you're looking for, extreme readings. So one of the things that I noticed back in 2007 was that home prices. I think in San Diego, I heard a measure that less than 15% of people that lived in San Diego could afford the average house in San Diego. Well, wait a second. How is that going to keep going? In 2000, the average PE ratio for the S&P is around 16. The PE ratio on the S&P hit 35. These are all extreme readings. One of the ones recently, bond yields. Boy, bond yields have gone all the way down into the close to the 10-year bond, close to 1.3%. Now we're back up quite a bit, but these are extreme readings. This chart here is of the volatility index. This is in 2008. The volatility index averages about 18. The volatility index measures the amount of fear in the market. It went up to 80. It had never seen 80 at all before. It hit it once, came back down, hit it again. These were the moments where people were literally freaking out. People were panicking on CNBC. They were just crazy. These are the moments where you typically see these extreme readings. So as an investor, as a trader, we need to be very conscious when we see these extreme behaviors, because this is the hallmark of tops and bottoms, of peaks and troughs. So to wrap this up, we've got our 4 business cycles. If you understand just this one simple thing, and then you look at GDP, and you see, oh, GDP is expanding, and then you invest money. Look, I'm not saying that you're going to be a dynamite investor and a great trader, but what I'm saying is you've got the odds in your favor. And if you recognize when the peak hits and we have all these extreme readings and you sell all your assets, you may not get the top. And actually, you know what? I'm going to go ahead and tell you, I will guarantee you, you will not get the top. You might be 6 months early. But here's what I can tell you is when the peak hits and the recession happens, you're going to keep a whole lot of your money. And if you're a trader, you're going to make a whole lot of money. I love bear markets. I love to trade bear markets. They're my favorite kind of markets. They're easier, they're faster, they go a lot more. So again, just understanding these business cycles is a huge thing, but don't try to time them because this is economics. This is a very slow moving thing. If you're going to be trading it, you should be using all technicals. There's a great saying in the market. The markets can stay irrational much longer than you can stay solvent. So don't try to time these markets based on economics and business cycles, but you definitely can put yourself in the right situation.